couple of years? For an explanation, we have to look at both the short term and long term. Short term market fluctuations could be triggered by anything, like shareholder speculation, bad news about a sector, changes in governmental policies, companies meeting or exceeding their projected goals, and the list goes on. I remember back in 2006 or 2007, there was a popular fast food restaurant in New York that was forced to shut down because the place had a rat infestation problem. Even after it was closed, you can see the giant New York City rats running back and forth inside the restaurant. Bad news like this made shareholders freak out, and the company saw a decline in their share price. After some time passed, the price of the stock climbed back up. You probably know which restaurant I'm talking about, but if you don't, just do a quick search online. Better yet, use YouTube. Fluctuations in the stock market are influenced by the market cycle we are in. During times of prosperity, the stock market is in a bull market, meaning an upward trend. In times of economic hardship and uncertainty, the stock market tends to be in a bear market, which is a downward trend. Besides buying stocks, you can also buy mutual funds, bonds, futures, options, commodities, index funds, and ETFs on the market. Companies on the stock market are all publicly traded companies. This means that these companies need to be transparent with their shareholders about their business activities. They also need to present quarterly reports called 10Qs and yearly reports called the 10Ks, along with an annual report. In order to get listed on the stock exchange, a private company on the primary market goes public through an initial public offering, allowing its shares to be bought and sold on the secondary market, which is the market regular investors like you and me have access to. A company only makes money during the IPO by selling its shares to the public. It's then in the hands of the shareholders who can trade with each other. Of course, a company keeps being the owner of a majority of their shares, and they can buy back shares if it makes financial or business sense. With all the different risk involved in the stock market, many people still invest in it because long term it has proven to be a great wealth builder. Chapter 3: How to Buy Stocks. Before you jump in to buy one share of stock or multiple stocks, you need to have a goal you want to reach. Are you investing for retirement? Do you want to buy stocks because you think you can make money fast? Or perhaps you want to get your feet wet and just gain some experience? Answering the thoughtful question, what your goal is, will determine what type of investor you will be, how much money you will need, and how long you should hold on to the stocks you are planning on buying. Answering this question will also determine if you are a short-term or long-term investor. Short-term investors like to buy and sell frequently within the same day or within a couple of weeks. These traders are called day traders and swing traders. These traders try to make money fast by buying low and selling high or short selling. They are in their trading accounts every single day. The stock market is open, looking for opportunities to make a profit. Long-term investors take a different approach. They still keep an eye on how their stocks are performing, but they take the long-term approach of buying stocks to hold for 5, 10, or many more years. If you invest for retirement, you would take the long-term approach. You should also ask yourself how much risk you are willing to take on if you buy stocks. The stock market can be very volatile, and you could lose a ton of money if you are not careful. If you are a young investor who has some money to play around with and don't mind the short-term up and down swings of the market, then you can take on a good deal of risk. But if you are close to retirement and want to preserve and grow your money, then you should be more cautious about investing and buying stocks. It's also a good idea to talk to a financial advisor or a financial planner. In order to start investing, you need an investment account. This account gives you access to buy and sell equities, also called stocks. There are many types of accounts on the market, but the more prominent ones are the 401k, IRA, Roth IRA, traditional brokerage account, the 403(b), and the education savings account, also called